ROE and ROCE are the most important ratios while analyzing a company. So, capital is that amount which is invested in any business and is fueling every operation. Almost all kinds of business requires capital, be it trading, manufacturing, or any other form. More or less, you will be requiring capital for every business. There can be two major ways to bring in capital. One way is by giving out ownership, and the other way is by taking loans. The money which is brought in by the owners of the business is known as equity. You don't have any obligation to pay back to the owners, nor you have to pay them any interest. But the profits of the business will be shared as per the proportion of the ownership. Whereas when you take loans, that is borrow money, you have to pay them a fixed interest and there is no dilution of ownership, but you will have an obligation to pay them back. Both of these, equity and debt, together form the capital of the company. So suppose you are starting a business and you bought in your own equity of rupees 100 and took a loan of rupees 100 from your friend. Then your total capital employed will be rupees 200. Now what will be the return on capital employed? ROCE. While calculating ROCE, as the name says, we need to find out how much return can a company generate on the capital employed by it. In our example, suppose we generated another 100 rupees in our capital of rupees 200. Then our return on capital employed will be 50%. And if you earn another 200 rupees on the initial capital of rupees 200, then our return on capital employed will be 100%. So the characteristic of value investing is to invest money in the business of the company and not just bet on the share price. So before investing into any company, it is important to check the returns it can generate. And since we have limited money, we should use it in the best possible way. So in case of Hindustan Unilever Limited, it can provide a return on capital employed of 116%. That means if you give 100 rupees to HUL, it can give back 216 rupees, an extra 116 rupees. Now, this is strictly not an investment advice. No doubt the company is great, but currently its valuation is not. ROE or return on equity, on the other hand, tells you about the returns generated by company for equity shareholders only. Like in our example, where we bought in capital of rupees 100 and took a loan of rupees 100, ROE will tell us about the return generated for equity only, that is for the owners or shareholders on the initial capital invested of rupees 100 only. Now, how should we take investment decision? By seeing ROE or ROCE. In our example, where 100 was brought in as capital and 100 was taken as loan, let us assume that business generated a profit of 200 rupees. And for the time being, we will ignore the interest paid on the loan. In this, capital employed will be 200, both equity and debt, and ROCE will be 100%. That is 200 upon 200. That means by using a capital of rupees 200, you generated 100% return of giving out a profit of rupees 200. But while calculating ROE, the denominator will be rupees 100 only the equity part, and numerator will be rupees 200. The return on equity will be 200%, while ROCE was 100%. So if you just look at ROE, the company seems to be very attractive. But it's important that while analyzing a company with debt, you check ROCE as well and don't be blinded by ROE. For a debt-free company like HUL, you can trust on ROE. In case of company with debt, let us check Cadila Healthcare Limited. ROE is 19% while ROCE is around 17%. Let's see the equity of the company. It is the sum of share capital and total reserves. This will be approximately 9,000 crores. Debt is around 3,000 crores. So ROCE here shows the profit of the company on 12,000 crores. 9,000 plus this 3,000. While ROE shows the profit on just 9,000 crores of equity. Thus, for a company with debt, we should choose ROCE over ROE. The first difference between ROE and ROCE is that ROCE takes debt into account. Now let's see the second difference. Let's go back to HUL where debt is 0. Here, ROE will be calculated as net profit divided by equity. We will take net profit of 6,000 crores with the sum of share capital and reserves in surplus. That is around 7,700 crores. That would give approximately 82%. Let's see Cadila again. Whenever a company has taken debt, it has to pay interest on it. So let us see. Here is the interest paid by Cadila. This interest is reduced while calculating the net profit of the company. So thus, while calculating ROCE, we do not divide net profit, but we divide the operating profit. Here, the operating profit of the company. That is 2,300 crores. As interest is the return generated for debt holders. And because of this, ROCE and ROE will be different for companies with no debt also. Here, for calculation of ROE, we will be taking 6,000 crores in numerator, while for calculation of ROCE, we will be taking 9,000 crores in the numerator. To conclude, ROCE doesn't consider taxes or interest, but just the return generated by the company on all the capital which is available with it. So in cases of no debt company, go for ROE, while if there is debt, look for ROCE. Then you should not always be very happy to see a company with high ROE and high ROCE, as they can very easily be manipulated. We know the calculation of equity. It is calculated as the sum of share capital and total reserves. Here, reserves are the profits earned by the company which is circulated in the business itself. And when dividends are paid, they are paid out of this total reserves. So paying off dividend would reduce the total reserves and ultimately reduce the equity of the company. Let's see this with an example of XYZ Limited Company. It has share capital of rupees 100 and reserves of rupees 100. Thus, the total equity stands at rupees 200. The company earns a net profit of 50. This company has paid a dividend of 20 during the year. Now, the share capital will remain same, but reserves will reduce by rupees 20, the amount of dividend which is paid. And the total equity would come to rupees 180. The net profit is rupees 50, so ROE will be net profit upon equity into 100, will be around approximately 28%. While if company does not pay any dividend, the share capital, the reserves and the equity will stand at rupees 200 only. Net profit will be rupees 50 and ROE will be rupees 25. So ROE has increased from 25 to 28 just by paying a dividend. Companies are aware that investors invest after seeing ROE. So many companies might increase their ROE and ROCE by paying high dividends. So don't forget to check if ROE isn't pumped up due to huge dividend yield of the company.